everyone, and welcome back to Market Insights, a series where we delve into interesting topics affecting equity markets. Today I have with me Cornelius and Jacques. Thank you guys again for being here with me. So, turning our attention to China, what have we seen with valuations over the past 3 years affecting the Chinese equity market?
So it's been quite a wild ride. The market is up just under 10% over the 3-year period, while experiencing drawdowns of 15 to 30% on 5 occasions. So the valuations on a forward price earnings basis has fluctuated between 11 and 12 times. So that 10% total return over the period is 5% earnings growth and 5% re-rating from 10.5 to 11 times. During this period, the MSCI All Country World Index has re-rated from 14 times to 18 times. So China hasn't benefited from the re-rating of global equities. It is a factor of lack of growth that China is seeing on earnings. Chinese earnings per share on an MSCI in China basis is the same as where it was in 2010 or 2011. So very depressing. And you can understand why China needs to trade at a big discount to global markets.
Great, thank you. So maybe we can spend a bit of time delving into the Chinese stimulus and the effectiveness of the policies that they've put through.
So China has announced a widespread amount of stimulus, both on the monetary as well as the fiscal side. In terms of the trade-in subsidies that they're giving to consumers, that's been very effective. So if we look at home appliances, where they started, that has been growing more than 30% year on year for 6 months. And more recently, they started giving subsidies on cell phones. So we can also see communication equipment growing more than 30% over the last couple of months. So whatever China is announcing is starting to work, but they'll probably have to continue with more stimulus because the consumer confidence is still at very depressed levels.
And just touching on that, looking forward, what do you think some catalysts would be in order to see that re-rating coming through?
Everything points to July. That is when the 90-day pause on US tariffs on Chinese goods comes up, that deadline. And it's also the month where the Politburo meets. So there they will review the economic growth for 1H this year, and then they'll start refining their policies.
Great, thank you. So Jacques, let's move on to you. With regards to the consumer stimulus measures that have been put in place, have you seen this pulling through into Q1 results of some of the Chinese companies?
Yes, so all of the big Chinese e-commerce players have reported their first quarter calendar earnings, and a key theme that stood out was the strong online sales growth from these players. This was driven by both subsidies and the government trading programs, and JD.com specifically benefited from this, showing strong top line and earnings growth numbers that beat expectations. Alibaba's Taobao and Tmall group also reported strong online sales, in part driven by a management strategy to increase monetization in that business. However, Alibaba is seen as one of the leading players in China's AI cloud space, and the market was disappointed by the margin in that business. I think it's important to remember as well that the capital intensity in that business is increasing significantly as the management team needs to invest in cloud and infrastructure to drive this top-line growth. Another key theme was the increased competition between the local players, and this had a pronounced impact on Pinduoduo. Pinduoduo's business model is a little bit different to JD.com and Alibaba's, where they don't benefit as much from the government trading programs. So the management team had to invest heavily into marketing and merchant subsidies to drive their top-line growth. Pinduoduo's international business also saw a significant slowdown in their top-line growth as the changing business model there and the effect of some of the uncertainties around the trade war started to weigh on top-line growth.
Great, thank you, Jacques. And to conclude, could you maybe give us a bigger picture, longer-term view of what we expect for China?
So China's invested aggressively into infrastructure and manufacturing, and we believe that consumption will be the main driver of GDP growth going forward. Household consumption as a percentage of GDP bottomed around the GFC, around 35%, and it's increased steadily to just under 40% at the moment, and we believe this growth will continue as part of a longer-term trend, especially if you consider the gap between China's GDP as a percentage of consumption and that of global peers. For example, the US is just under 70%. Another important factor is the savings rate in China is very high. So this indicates a lack of confidence from the consumers to spend. And as consumer confidence increases and comes back, this will be another tailwind to consumption growth.
Brilliant. Thank you guys so much for your time today. It's going to be really interesting to see these themes playing out in the future. If you have any questions or any topics you'd like us to cover in future, please would you send those through to us. We'd be happy to look at them next time. Please feel free to join us on the 12th of June for our Equity Explorer session, where we'll be delving into digital advertising. We'll be looking at primarily Meta and Alphabet. Thank you so much.